All right. Good afternoon, everybody. Welcome back to another world famous self-directed IRA class every Tuesday at noon with Quest Trust Company. Quest Trust is the voice of self-directed IRA education. Very excited about today's guest. Good buddy of mine, somebody I've known for almost 10 years now, Adonis Lockett from L&H Capital up in Dallas, Texas. We're going to have a lot of great information for you, whether you're a seasoned investor or a new investor. Adonis has great info for you. So I've just got a few slides I want to run through real quick here, make you aware of some things going on with Quest Trust. And if you're new to Quest, give you an idea of who Quest Trust is. So who is Quest Trust? We're the largest self-directed IRA custodian in the state of Texas. We're the fastest growing in the United States. We currently have 18,000 active investor clients across the United States. So though we're Texas-based, we service clients all across America. We currently have $2.5 billion in assets under administration with 100 employees across our Houston, Dallas, and Austin offices, 34 of which hold the prestigious Certified IRA Services Professionals designation. And pay attention to this because at any point in time at Quest, we can have anywhere from 400 and presently 475 million in undirected cash. But notice the disclaimer at the bottom, guys. Quest Trust isn't attorneys, CPAs, tax advisors. We're not here to endorse any products or services of any kind. This webinar today is strictly for your education. Whenever you're doing investments, whether you use an IRA or not, we highly encourage you to do your own due diligence, vet the people, vet the deal, so that you feel comfortable with any investment that you're doing that is in fact going to be a good investment for you. So if you think about what a self-directed IRA is, in reality, guys, there's no difference between an IRA at Quest and IRA at Fidelity. The difference lies in what you're allowed to invest in. With Quest, you can invest those retirement dollars in alternative investments outside of the traditional stocks, bonds, mutual funds. We specialize in real estate, notes, and private placements. So some of the benefits, you get some diversification. I would say real diversification. You're not just diverse, spread out a bunch of mutual funds or a bunch of stocks. You truly have the best of both. You have those private investments. You also have those public investments. So you are truly spreading out and mitigating your risk. Tax benefits, guys, it really comes down to this. This is a tax shelter. When you invest with a self-directed IRA, you could potentially get a deduction on your taxes. You can also shelter those earnings from capital gains taxes. This is a tax exempt entity. Keep that in mind. Social investing, this is where we get to give back to the community. As investors, we have an opportunity in some cases to put a roof over someone's head. We also have the opportunity to improve neighborhoods. We also are employing local people in the economy, general contractors, roofers, landscapers, etc. So don't dismiss the power of being able to give back to your community while investing at the same time. And also the biggest one I think that you want to think of when a benefit to IRAs is investing in what you know best. We sum that up with one word: control. You're the expert. You're the fiduciary. You're going out and vetting these investments. If you're a flipper, if you're a guy who likes to invest in syndications or loan money passively, and that's your bread and butter, you get to do that inside of the self-directed IRA at Quest. I want to make everybody aware that we are getting back to our in-person events across our offices in Houston, Austin, and Dallas. The first Tuesday of every month in Houston, second Tuesday of the month in Austin, third Tuesday of the month in Dallas at 6:30. We're bringing out speakers from across the United States. But most importantly, we're giving you guys the opportunity to network again in person, bringing that back, that personal touch, find the deals, find partners, find access to capital, find other people's IRAs, leverage each other, grow your network, and use Quest as a conduit to help you build that network and ultimately play a part of your overall success. The fourth Wednesday of every month at 6:30 Central Time, we do a virtual networking happy hour. This is with investors and people from all across the United States. So wherever you're looking for deals, wherever you're looking for access to capital, partners, again, this is a way to do it from the comfort of your own home. Grab a drink, network, and again, continue to expand and grow your network, which is ultimately going to help grow your portfolio. But all roads lead to this, guys. This is the biggest event that we do. This is one of the biggest and best events across the entire industry, not just with IRAs, the entire real estate industry. The third annual Quest Expo is coming up September 23rd to the 25th at the Westin in the Galleria in Houston, Texas. We have a limited number of early bird tickets remaining. So take advantage of the already discounted prices and save even more by using the special coupon code POWER30 to be able to save an additional $30 on your tickets. You don't want to miss this event. This has people from all over the country educating on very specific topics across real estate. It can be syndications, it can be self-storage, it can be assisted living, lending, legal. Everybody needs legal advice. We're going to have a dedicated legal panel. So make plans to be in Houston this September, and also make plans and save some money on those already discounted tickets using the coupon code POWER30. How do you get in touch with an IRA specialist? It's very easy. You can go to questtrust.com, chat with an IRA specialist live in person in real time. Give us a call, pick up the phone. No, it's an old school approach, but we love that personal touch. 855-FUN-IRAs. Give us a call, talk to a live human being, get your questions answered, let us help you. Or you can email us directly at iraspecialist@questtrust.com. We're eager and ready and willing to help you with any questions that you have. So please leverage us, use us, and to your success, we hope we can play a small part in that. So that's all I've got for my slides. I want to bring on my good friend, Adonis Lockett. I've known Adonis for, about a decade.
Yeah.
I knew him in my previous life when I lived in Kansas City and helped build a company called Think Realty. And I've known Adonis ever since. And since I moved to Texas a few years ago, it's just been great being able to kind of be in your backyard and kind of reconnect and see how we could do business together. And I've always been impressed with you, and I'm very grateful that you're part of Quest now. So Adonis, take it away, man. Look forward to hearing you.
Well, one, thank you for the gracious introduction, and likewise, Kurt, what you're doing and what Quest is doing has been, one of the things I've always admired. Quest has been a very big presence in the industry, and I've always wanted to be part of anything Quest related. So this is actually was something on my vision board years ago that I'm now able to kind of check off. So I definitely appreciate you having me. And I do think that the information that I'm going to be speaking about this afternoon is going to be beneficial. And what I wanted to do is I wanted to do something a little bit different in the topic that I'm discussing. What I wanted to do is I want to talk about leveraging private money to start, grow, and scale real estate. But I want to talk to both sides of that transaction. I want to talk to the person that's borrowing the money to start, grow, or scale. But also, I'm speaking a lot to the person that's actually wanting to, or getting into lending money. So this presentation is actually going to talk to both perspectives, and I'm going to kind of talk through some of the educational yays and nays, do's and don'ts on both sides of it. One as a lender, but then two as a borrower. So at the end of this conversation, everyone will kind of understand how each of the other person is thinking. All right. So I want to jump right in. Leveraging private money to start, grow, or scale your real estate business. So first, just a little bit about me. I'm your speaker. I have a bachelor's of science degree in electrical mechanical engineering. I am Six Sigma Green Belt and Lean Engineering certified. I have worked at NASA as an aeronautical engineer, Caterpillar as a test engineer, Boeing as a quality assurance engineer for commercial airplanes, again, Boeing as a satellite antenna design engineer, Lockheed Martin in New York as a reliability engineer, and then I moved to Dallas in 2009 as a rocket propulsion test engineer for Lockheed Martin. I quit Lockheed in 2010 to start my own real estate investment firm. And since then, since establishing Lockett & Homes, I have 15 offices in 11 states. I'm a licensed real estate brokerage in 3 states, a licensed mortgage brokerage in 3 states, Texas, California, and Florida. We are a real estate investment firm. We are a wholesale company. We are a holding company. And we've spun off the lending division actually to probably one of the biggest income producer in the company, L&H Capital, which is a national direct private money lender. I personally have purchased and sold 117 houses to date. This is me personally. I currently own 54 rental houses in the Dallas market. I've purchased 3 apartment complexes. I have participated in over 5,000 private money loans nationwide. I am the principal and director of operations of My RE360, a real estate tech startup that pretty much is a central hub for everything real estate investing, from education, deals, and vendors. And just a quick tidbit, my first 16 deals that I flipped, my lender was actually someone using their IRA account to fund my deal. So when I first got into the business, I didn't even know exactly how this worked, but I could tell you every month I wrote a check to Quest IRA directly for my first 16 deals. So it was funny, actually, as I started to learn how Quest allowed people to direct IRAs, it just kind of took me back, and I realized that I actually got into the business with my lender, my first lender being actually a self-directed IRA, providing capital for my deals. So that's a little bit about me. I always like to do like a fun fact, right? Just to kind of, make this less serious. So a fun fact about me, I was actually on American Gladiators. When I was 23, when American Gladiators came back, I was actually a contestant on the show. I met Hulk Hogan. As you can see in the bottom left corner, this is me getting thrown off the wall. But yeah, fun fact about me, I actually was a contestant. I won my episode. Didn't make it past the first episode, but fun experience. So, I want this presentation to be fun. I want this presentation to be informative and not so formal. So you will hear me crack jokes and kind of make snarky remarks. But again, it's all in just kind of balance the seriousness of this topic to make it just a little bit fun. So the things I'm going to be discussing: what is private and hard money? Why leverage private money? We're going to talk about using private money as a borrower. We're going to talk about providing private money as a lender. So I'm going to give you both kind of perspectives, the do's and don'ts, some of the things you should know if you're borrowing private money, and some of the things you should consider if you're looking to loan money as a lender. Some of the resources and strategies to protect your money should you actually decide you want to actually loan it out. Some strategies to hack growth. This is one of the things that I feel like is not often talked about, but just a couple little tips and tricks that I would recommend for anyone looking to deploy capital. A couple things they can do to hack growth. The different vessels to deploy your capital, and I'm gonna dive into that in a moment. And pretty much close out with a Q&A if there's an opportunity to have any questions answered. All right. So what is private money? First thing I'm going to do is I want to kind of make a correction. The terminology is changing. Institutions are now fancying themselves as private money lenders. And ironically, the institutions are now pushing for individuals who are loaning money. You're now considered the hard money lender. So at these private lending conferences all over the country, quarter after quarter, the industry is actually moving away from hard money as a term because the private lending industry is now heavily institutional backed. The individuals loaning money are actually now becoming the less common and the less frequent. And because the individuals who are loaning money are still utilizing practices that are 5, 7, 10 years old, you as the individual are no longer being considered the private lender. You're actually being considered the hard money lender. So you'll hear me reference the term private money lender a lot more often in this presentation. But just to kind of give you an idea, they're typically one and the same, but the industry is trying to change the actual definition of private money versus hard money lender. So just something you should know. But a private or hard money loan is a specific type of asset-based financing through which a borrower receives funds secured by real property, guaranteed by an actual borrower. 7, 8, 9, 10 years ago, when I got into the business, we didn't have to personally guarantee these loans. The loans themselves were strictly about the property. You'll notice nowadays you are hard pressed to find anyone, private or individual or institution, that's going to provide a loan without requiring a personal guarantee. So, again, this is part of the evolution of the business. Just in the last 2 or 3 years, I've actually had to add that final statement, guaranteed by an actual borrower, because before, hard money loans were literally just based on the asset and didn't really take much about the borrower into consideration. I think those days are pretty much behind us. Hard money loans are typically issued by private individual investors, such as someone who has a lot of money in the bank, someone who has a lot of money in a retirement account, hedge funds, or institutional agencies. And again, I can easily tell you the institutions are outnumbering the individual investors. I want to say the ratio is now 6-1. So for every one private money loan or private money individual who's lending money out, you actually find about 5 or 6 institutions, agencies, or firms that are pushing out money. Interest rates are typically higher than conventional residential property loans because of higher risk and fewer borrower requirements. So the hard money industry, yes, it is evolving. but it still sticks to the basic principles that you're going to pay more fees and higher rates to get money that's deployed a little easier than you would in any bank or conventional financing. Most private money loans are typically used for projects lasting 6 to 24 months. Again, that is still true today. But now, again, as part of the evolution of the industry, private lenders are now offering long-term rental loans at 30-year fixed terms with slightly higher interest rates than you would conventional loans. So when the when the rates were down in the high ones and twos, believe it or not, the private sector was offering 30-year fixed PITI rental and landlord loans as low as 3.5%. So the private sector, it has now evolved into holding 30-year loans for investors who are securing rental portfolios. And again, the private individuals, if you want to take some of the volatility or risk out of the market, we've seen a lot of private investors kind of move over into this sector and park their money in a secured instrument like real property. So this is actually a very big thing in the last 3 or 4 years. So why leverage private money? Let's first, as a borrower, when you're leveraging private money, first of all, you're leveraging someone else's money to secure deals. This allows you to multiply your returns using the same funds you would for a cash purchase. A couple things that a lot of people don't consider is that you can actually extend your network through other people's resources. So believe it or not, early in my investment career, my lender was actually my biggest outlet for finding a good title company, insurance company, and even sometimes a general contractor. So, your lender will actually have a reach in different aspects of the market, know a lot of the players in the space. So your lender may actually be a great resource to expand your network. My lender actually at one point was also a very solid additional channel for deals. So my lender would have access or would have deals that they were preparing to fund where the buyer didn't perform or there was something funky that caused the deal to not go through. So I was able to step in the 11th hour and take on deals that fell apart. And sometimes I would even get it at a bigger discount than the initial buyer was already getting. But my lender actually was one of the people I would call on a monthly basis to say, hey, do you have any deals that you can flip my way? And a large chunk of my volume actually came from my lender. Another thing, your lender will qualify your deal and verify your profitability. Now, I've had deals that I knew were slam dunk deals that my lender told me, hey, when you crunch the numbers, not only are you not going to make money, you're going to actually lose money. And when they were able to put pen to paper and show me, my lender was actually able to save me from getting into several bad investments, because at first glance, I'm looking at my gross, and that my gross looked phenomenal. When you actually pencil it out, my net was actually negative $5,000 a couple times over, especially early in my career when I wasn't factoring in a lot of the costs that I would to incur during the loan process. So your lender will actually be a great source to confirm if your deal has legs. And don't be modest in asking, because I tell you, they will be very vocal about it. So as a lender or as an aspiring lender, why private money? Well, first of all, your investment is secured by real property. So unlike, the market, your investment is secured by real estate that is tangible. In addition to the fact that the market is on fire right now, I don't know any markets that are not growing pretty aggressively year over year in the equity. Now, granted, we are set to plateau out especially with rates going up. The market will plateau, but I think we are quite a ways away from any decline, and definitely any version of a crash. So you're parking into real property. The market is on fire right now. And nowadays, borrowers are more savvier than they were in times past, especially those who were affected during the recession. You'll notice that borrowers are doing a lot more research. They're understanding a lot more about the requirements and the consequences of getting into a deal being uninformed. So borrowers are understanding, they're spending a lot more time researching, understanding the nuances of taking on private loans. And a lot of them are planning for these investments with a fair amount of capital. So from the lending side of it, you're watching borrowers who understand that knowledge is power versus, 7 years ago, if I wanted to get into real estate, I made a phone call and I got a loan ready to go. And, we saw how that went. And another good thing to consider is that, from the lending side of it, if a property does go into default, you can take possession and exit the deal quickly, especially in the state of Texas. Ironically, of course, you got to go through the proper protocols, but in Texas, you can actually file for foreclosure anywhere from the 1st to the 13th, and the first Tuesday of the following month, you could go to the courthouse and take possession of your property. So we're talking 3 weeks from the time you file to the time you take possession in the state of Texas. In addition, with the market moving as quickly as it is, you can actually, contact your investor who is in default and say, hey, listen, before we go through the process of being foreclosed on, why don't we just sell the property? You avoid a foreclosure. I avoid the costs associated with it. And I can pretty much confidently tell you, if you've generated that loan properly, that property will move quickly. Someone will step in and take it over. So it's very easy to get in and out. Another thing that what's great about the lending side of it is that you can impose risk mitigation strategies to safeguard your investment. So I'm going to jump into that in a few minutes, but there are things that you can do to ensure that there will not be a default if you're loaning money out. And by these creative strategies, you can actually position yourself as a very competitive lender or capital provider in the space. So I'm going to definitely jump into that in a moment. But more importantly, you can actually pick your borrower. You can mandate your borrower and your risk profile. So if you decide that, hey, if I want to loan money out on real property, you can actually pick the worthiness of your borrower from a credit perspective, from an experience perspective, from a cash reserves perspective. You can literally identify and choose your risk, right? And the great thing about that is that if you want to be a little bit more riskier, you can charge more. And borrowers who know that they have credit challenges or have a few challenges know that they are risky and are willing to pay more. So you can actually pick your risk reward appetite, and then from there, put parameters in place to safeguard your investment. But again, it allows you full control of how aggressive or how safe you want to be if you're deploying capital. All right. So let's talk about using money as a borrower. Let's talk about using private money as a borrower. Whether you're on the borrowing or the lending side, if you understand the rationale behind the person on the other end of the transaction, it'll help you deploy money easier. It'll help you understand the requirements to get money quicker as a borrower. So understanding or using private money as a borrower. First thing is no pay stubs, no tax returns, no W-2s, no DTI requirements, no income verification. So the great thing about the private sector is that very often your lender or the lender does not care about how much money you do or don't make, right? Income is one of the few things that ironically mean absolutely nothing because what the lenders will typically care about is, do you have the ability to successfully navigate the deal? Can you get in, pay the bill, and exit the loan? Number two, do you have the capacity to get into the deal, financially push it along, and then exit? So usually for a private money or hard money lender, what they're more interested in is you getting in and performing, paying the bill, and giving them their money back. So how much you make usually does not fall in one of those things that they care about. Another great thing is that as a borrower using private money, loans can be initiated quickly. As a hard money lender, private money lender myself, I've had instances where my borrower has contacted me on a Monday, and Wednesday we had docs ready for them. So depending on the lender that you're working with, the relationship you have with that lender, you can get loans turned around, like deployed, sometimes as quick as 24 hours. So it allows you to be very aggressive when you're going to find new deals. It allows you to be very aggressive in the offers that you make based on how quickly your lender can turn around that capital. Another great thing is that you become a lot more competitive as a buyer when you're presenting your offers as cash. Now, this is kind of a blurred line, because some lenders in the private sector will say don't present it as cash, whereas others, or a large chunk of others, will say, well, technically, since we have exceptionally fewer requirements for our capital to be deployed, we're actually okay with our buyers presenting offers as cash because of how quickly the deals can be turned, how fewer requirements we have, thus essentially allows the deal to operate as cash. So as a borrower, some of the things some of the major issues that you'll have with going with banks or conventional lenders, you won't have in the private sector. Obviously, the big one being the income piece, no one cares. The next part of it being borrowers, you can present offers as cash, right? So another great thing is that funds can actually be provided for purchase and rehab. So not only will you get capital to purchase the deal, you will actually get the funds to renovate the property. And that's where you'll find a lot of the obligations come in. Or a lot of the offset of the obligations is because your private money lender is going to finance the purchase and rehab, right? So a lot of cool things. Again, the ability to turn money quickly, the no income aspect of it, and your actual deal being funded for the purchase and rehab. Now, on the other side of this, if you're the one that's actually providing money as a lender, I'm not going to talk necessarily to the pros, because we're pretty familiar about the pros of being on the lending side. What I want to do is talk to you about the best way to go about deploying capital and some of the things you should be mindful of if you're looking to get into it, or even if you're currently doing it. The first thing you want to do is have your resources in place to deploy your capital. Obviously, you want to have a custodian and a no-brainer, Quest as your custodian for the placement. But you also want to make sure you have a good mechanism to find you the deals and the borrowers you want to finance or provide capital for, right? You want to operate from a clear set of loan guidelines that you adhere to. So the number one kind of setback you'll hear borrowers would complain about when dealing with private individuals was the subjective element of working with an individual. As a lender, you want consistency when you're deploying capital, and you want people on the other end who are receiving that capital to know that if they adhere to a set of guidelines, that the money will be deployed. The easiest way to make yourself not be considered for future deals or future transactions is to have a subjective or kind of a moving target of the deals or the borrowers you want to provide capital or financing for. One thing you also want to have is consistency in the means in which you evaluate and approve a deal. So essentially So essentially what that means is that when you're evaluating a deal or a borrower, you want to make sure that whatever requirements you outline, you're consistent in that. So even if it's a property that's in an area that you are not necessarily a fan of, the question the rhythm you want to get into is, does it meet the guidelines that I've set? Does the borrower meet the requirements I've set for them? And if the answer is yes to both of those, you want to stay consistent in the way you evaluate and approve a deal. You also need to understand that issues will happen, which may cause a loan to delay or need to be extended. One of the biggest complaints I think I had personally when working with a private individual was that, this was someone who loaned me money out of their retirement account. The project ran long. So at the end of 6 months, I told them I needed an extension, and they didn't want to offer me an extension because they wanted their money back. So now they're in a tough situation. I'm in a tough situation. And what it boiled down to was that my lender at the time did not understand that in real estate, nothing goes perfect. And because they didn't understand that, it put them and me both in a tough situation that ultimately ended the relationship. So if you're going to be deploying capital, understand delays are going to happen, issues are going to happen, and you have to be fluent and flexible when it's needed. If you're providing capital, be strict but fair. This is an industry that borrowers will take every inch you give them, right? So you want to be strict when you're providing capital in your fees, in your process, in your requirements, and your guidelines, but be fair. One thing I would always recommend is do not take advantage of someone who is in need of your services, because when you help people and not take advantage of them, the amount of business that will be returned to you is tenfold of what you would get if you were to take advantage of their situation, charge them excessively, et cetera, et cetera. So I say be strict but fair. Be strict and hey, here's what my requirements are, but be fair when you're discussing fees, because you'll find that in this business, the relationship will always pay for itself in the long term versus the one deal that gets you rich. Safeguard yourself from defaults. If you're going to be deploying capital, no matter how strong a borrower is, life happens. And so there are different things that you can do to safeguard yourself from defaults. And one of which would be, consider rolling mortgage payments into the loan so that there's no opportunity for a borrower to default on a mortgage payment. Make sure you have resources in place so that if a borrower does default, you have a way to clearly recoup your money, or you have the means of going through the foreclosure process and then not pretty much bankrupting you. So there are different things you can do to safeguard yourself from defaults. We're going to talk about that in a little bit more. But while you're safeguarding yourself from defaults, you can actually be creative in ensuring your investment and your return. And what I mean by that is you can actually do safeguarding and being creative kind of one and the same. So if you're going to offer a loan to a borrower, especially if they're newer to the business, one of the ways you can safeguard yourself from the borrower overextending is by including all the mortgage payments into the loan. Now, by doing that, you now set yourself apart as the I don't have mortgage payments type of lender. So now by you safeguarding yourself, you're now being creative and making your name for yourself in the industry. So not only are you ensuring that your returns are going to be had because those payments are rolled into the loan, but you're now mitigating your risk or mitigating the opportunity from a payment default from your borrower. So you kind of get a 2-for-1 employing a strategy such as that. Have backups in place to handle affairs and make decisions should you become incapacitated. One of the worst things that happened to me when working with a private individual was that I believe he was injured, and for 2 weeks while I'm trying to sell a property, I could not get a payoff. There was no one else that I could talk to. And so for 2 weeks, we just sat idle waiting for a payoff to come. So what I'm going to recommend for those who are looking to deploy capital, have backups or redundancies in place to make sure you are not a single point of failure. Most importantly, do not under any circumstance loan to own. If the real estate investing industry, the real estate industry is small. You do not want to be the person that loans to own. And what that means is that sometimes when you're deploying capital, there is going to be a deal that is in the perfect neighborhood, that has really low leverage, that has $1 million of equity, that is just every vision or every version of a perfect property you could ever want. What tends to happen with private individuals is that they forget the fact that they provided money as a lender, not provided money as an investor. So what will happen is anytime a borrower gets into a small situation where there's a deal, where they're a month or two late, the private lender would then accelerate a foreclosure because the property has $1 million of equity. The property is in this perfect neighborhood. There's a $400,000 balance on $1 million value. And the individual as the lender has now taken a fancy to that property. Do not, if you cannot control your urges, or you yourself cannot balance out a fiduciary responsibility to the people you're doing business with, then you should not be providing capital. But under any circumstance, do not go into a situation looking at it like, well, if the borrower defaults, I can always take the property, and this would be a great property for me. The first time you say that statement to yourself, you've already gone down a road that is probably one that you don't want to, because your borrowers, the people around you who are getting money from you, will see that as an intention. And the first time someone believes you're loaning to own, that is one stigma that is very tough for you to shake, and you do not want to be the loan to own person. So if you are going to get into the lending aspect of the business, I would highly recommend, sticking to some of these core principles, and you'll find, great success as you start being able to turn capital quickly. A few resources and strategies that anyone should consider when you're looking to deploy capital, right? First and foremost, the resources. Structure the loan with some or all the payments rolled in. This is kind of where I mentioned that you can be creative and safeguard your investment, right? Structure a loan where if you're going to loan a borrower money to purchase the property and to rehab it, include 3 or 6 months, 9 or 12 months of mortgage payments into the loan. This will ensure that, one, there's no opportunity for a default. This will ensure that whatever you're charging the borrower, you will get paid, or at least will be made part of the payoff. And it just allows you to have the borrower come back, because it's one of those strategies that not a lot of people are employing. So the rolling the loan payments is as a suggestion, but there are different things that you can do, right? So let's say you want to roll in all closing costs, right? This again will allow the borrower to have a little bit more money so they can focus on the deal. And most borrowers, when you get these really creative private lenders, they don't want to disappoint, because they want to come back to you and have the opportunity to take advantage of these really creative or really cost offsetting loans. So you'll find that the more creative you are, the more of a commitment you'll get for the people you're loaning money to. With that said, leverage conservatively to allow multiple exit strategies. So if you are going to loan money to an investor for the purchase, rehab, and include mortgage payments, or if you're going to cover closing costs, make sure that you do not over leverage that prohibits you from getting out of the deal should something go left. The worst thing that you can do is provide a loan, and no matter whether it's refinance, whether it's sold, or whatever the exit strategy employed is, there's going to be money needed to be brought to the table, or you're going to be upside down in the deal. You do not want to be in that situation. So if you are going to be creative where you're covering closing costs, covering mortgage payments, make sure the leverage is conservative enough to where, should you need to execute any exit strategy, whether borrower is selling, whether they're refinancing, whether you have to take the property back, there's enough margin or meat on the bone that allows you to exit the loan and still have a little bit of cushion. One of the other things you should probably do if you're going to be loaning money, especially in high volume, is you want to identify and create relationships with NPL or non-performing loan note buyers. And the reason why this is something that you should really consider is, if you're going to be loaning money, especially to new investors or investors who have credit challenges, who have financial constraints, you want to put yourself in a position where if the borrower defaults and they are behind 3 or 4 months on their payment, you don't have the capacity, or you don't want to go through the process of foreclosing. Have a relationship with a non-performing note buyer, because those people will come in and buy the note from you, or essentially they'll buy the deal from you, give you your money back, or at least in most cases give you most of your money back. But you don't have to go through the process of foreclosing. You don't have to go through the process of not getting paid anymore on the mortgage payments. You can actually hand that responsibility, and more important, the liability, off to someone and let them deal with it. So one of the things I would highly recommend for anyone who's going to be deploying, if you're going to be issuing loans 3 or 4 times a year, at least know a non-performing note buyer. So this way, should there be an issue where the borrower is not making payments, you have a quick and easy way to exit without going through the foreclosure process. And again, depending on what strategy you're implying, ensure that the borrower puts money in. And if you're going to have a no down payment, cover all closing costs, make sure the borrower has cash reserves. The one thing that you'll hear people say often is that I bought real estate with no money. You didn't. You bought real estate with someone else's money, or you bought real estate with leverage or debt or something like that. But there's nothing more frustrating than hear these statements. I bought real estate with no money. The borrower, the buyer, they didn't go to the title company with spices and furs. They didn't barter, goods and services for a deed. There was money transacted somehow. So if you're going to be deploying capital to a borrower, even if you're going to cover mortgage payments, cover closing costs, make sure that they have cash reserves to at least push the project along, to cover incidentals. Make sure that they have the means to not just stall out the moment that the deal closes. Now, the other cool thing that you can do is, again, since you're the one deploying the money, you can set the parameters of who you want to loan money to. So if you want to only fund borrowers who have done previous deals, now you can offset your risk by saying, hey, I only want to loan to investors who've closed 3 transactions. I only want to loan to investors who owns a rental property or owns their home. So if you want to kind of, do little tricks of the trade, and your thing is, hey, I'm going to be really aggressive. I'm going to offer no down payment. I'm covering closing costs. I'm covering mortgage payments, but I need to know that the borrower will not just mess this up. So they need to have 5 deals done. So whatever you want to do, you can create the requirements for the person that you want to loan money to. And from there, you can now get creative if you feel that the borrowing person is strong enough for you to employ some of these creative strategies. You also want to make sure you have a credit score requirement for your borrower. Granted, this is a private money loan, but this is the litmus test that we in my office as a lender, what we ask ourselves. If I have a borrower or someone who wants to borrow $250,000 from me, and I look at their credit, sometimes a credit score is not indicative of a borrower's credit worthiness. A credit score is not indicative of a borrower's credit worthiness. For full-time real estate investors, the difference between a 740 credit score and a 630 credit score can literally be 2 credit cards maxed out. So 2 credit cards will be the reason why the borrower is A paper or D minus. So the borrower's credit report should be an indication of their credit worthiness, not necessarily their score. However, the score is an indication of let me just be very clear for all of my full-time real estate investors. You all know this. Whenever I'm taking on a loan, whenever I'm about to get a new loan, I will pay all of my credit cards down to 10%. Once the statement's closed and my credit score is 750, I will swipe all of those cards up. By the end of the week, all of my cards are maxed back out. The credit score manipulation is what real estate investors have to do, because credit score is the basis for their worthiness, not their credit reports, right? So me at a 750 credit score does not change the fact that I've had credit for 17 years. I've never had a default. I've owned 5 cars. I've never had a late payment once in my life. Never had a collection. Never had anything. But because my 2 credit cards are maxed out, I'm now considered a D minus credit. Not true. By having a credit score requirement or a credit worthiness requirement, what you can do, consider this. If your borrower is not paying their car note, they haven't paid their credit card bill in the last 2 months, then it's a good chance they may not pay the mortgage payment that you've loaned to them. So you want to try to be mindful of a borrower's credit worthiness just as much as their score. But you want to have a requirement. If a borrower is not going to pay their car note for 2 months, the credit card bill for 2 months, they probably won't pay your mortgage payment the moment the money gets tight. So that's usually something you want to have. Next thing, consult with an expert on industry standards and practices. There is nothing, the same way we as lenders dislike when borrowers come in and are all over the place doing stuff that is not common to the standard loan process. As a borrower, no one likes a lender to come in and impose things that are outside of scope, right? So my lender coming by and bringing people and touring my house. I don't want my lender walking in my house. That wasn't our agreement. Our agreement was for you to loan me money, not parade around a bunch of people saying, hey, look at the money, look at the property I invested in. So get with an expert and make sure that you are operating to industry standards and practices, because you will find that trying to learn this as you go may be very costly, both in your capital and in heartache. Do not reinvent the wheel, right? There's a reason why there are standard operating procedures. There is a reason why there's industry standards and practices. So figure out what those are, figure out what works for you, but do not reinvent the wheel. Do not try to just learn as you go. Actually take the time to be informed or have someone on the team who understands the business. It is very frustrating to work with someone who is such an important function in the transaction like your lender, and to hear that your lender has no idea what they're doing. So if you are going to start deploying capital, have someone on the team that understands the business, that's in the business, that exercises industry standards and practices, but be informed. Most importantly, have your resources in place before you deploy capital. Know what your exit strategies are for non-performing borrowers. Know the proper attorneys. Have your servicing company, or if you're going to service your own loans, have everything in place before you deploy capital, because what you don't want to do is be the bottleneck or an issue for a borrower who is just nailing it and you're fumbling the ball the whole way through. So have your practices in place, have the industry competencies of standards and of the standards and practices, and have your resources in place so that the process and the transaction is seamless. All right. So with that, having your resources in place. So what are some of these resources that you can use to protect your investment? So one of the big resources that I use is my RE360, my Real Estate 360. This website or this platform is pretty much the epicenter for everything real estate investing. So there is a forum to actually educate investors on the different aspects of real estate investing. So a lot of times when I have a new borrower, a borrower who's doing their first deal, I will send them to this platform and I will say, hey, you need to watch the videos about insurance. You need to properly understand all the ways to protect your investment, because by protecting your investment, you're protecting my money. I also have them watch introductory videos on what private money or hard money lending is. So there's a slew of different videos that these investors could come on and watch. And it's literally everything under the sun, from wholesaling to flipping, to how to navigate private money loans, how to leverage insurance. So this is a great place for people to come learn new topics or expand their core competency in real estate investing. There's also this same site has a mechanism to find investor friendly vendors. So a lot of times when investors are asking me to refer them over to a title company or refer a good insurance company, I will send them to this website and they can actually sort through different title companies, insurance companies, agents, or whatever it is that they need. All these different investor friendly vendors are right on the platform. And then for even those who are still looking for deals, there is actually a deal center that will help investors find deals in the local market. So Dallas, Houston, Austin, I think there's like 35, 40 markets that MyRA360 has a presence in. But essentially, whenever there's information that an investor wants to know or need to know, I send them there to learn. Whenever they need a vendor, an insurance company, title company, whatever it is, I send them there. Whenever they're contacting me saying, hey, do you have any deals that fell through? I'm looking for deals. I send them there. So this is a very, very solid resource. And the great part about it, that this website and this platform is free. It's free for vendors. It's free for buyers, for sellers. It's free for everyone. And you'll see that a lot of the resources that you need will actually exist right on this platform. So I definitely encourage everyone, whether you're on the borrowing side or the lending side of the business, know what resources exist in your market. Know the investor-friendly vendors. Know what the deal market looks like. If you're loaning money out, go to the website, browse through the deals and see what deals are trading at. get familiar with what wholesalers or what these deals are coming out at, just so you have your ear to the ground about what's happening in the market. And so with that said, now that we kind of went through some of the strategies to protect yourself, some of the resources, I want to talk strategies that hacking growth, right? So if you're going to be deploying capital, one of the things that you want to do is figure a way to protect yourself, get a return on your investment, have your resources in place, but then hack growth, right? So if you're going to be deploying capital, one thing you should consider is funding deals and then sell the note immediately, right? So the reason why you may want to go about doing something like that is that you can collect origination fees on your loan and have your investment returned to you in a matter of days. So let's just say I have $500,000 in my account that I want to loan to one of these investors. I'm going to finance a deal for $400,000. I can actually finance the deal, deploy my $400,000, charge the borrower, let's say 2.5 points, right? So I can charge the borrower $10,000 in my origination fees. And then once the deal funds, I can actually sell the note to a note buyer and have my $400,000 wired back over in as quick as 3 to 5 business days. So that means in 5 business days, I've put money out, made $10,000 and got my $400,000 back. And now I can do it again. You'll be surprised at how quickly your $500,000 investment will turn into $1 million by funding the deal, selling the note. Here's another thing about selling the note. If you do employ this particular strategy, once you sell that note, 9 times out of 10, you have no more obligations for the performance of that loan, meaning that once that note is sold, if the borrower defaults, if there's a foreclosure, that has nothing to do with you. It is now the responsibility of the note buyer. So for those who have a lot of money that you got tied up in the market, just think about how quickly or how long it would take you to get $10,000 return in the market with factoring in volatility, as opposed to funding a $400,000 loan, selling it off to capital markets, your note buyer, and getting $10,000 back and your whole $400,000 back in 5 days, right? So that's one of the best known kept secrets for how private individuals can scale and have exponential returns on their investment with little to no risk. Another thing you should consider, set up third-party servicers that handle payments and paperwork. So now a lot of times the fees that you're going to collect in the servicing, I know a lot of individuals like to keep that type of stuff in-house. Well, the one thing you want to do is focus on growing the business, right? So if you have someone handle the servicing part of it, and I think Quest may even be a vessel for that, make sure that you yourself are not handling fees and paperwork, payments and paperwork. Make sure there's someone else handling that so you can just focus on the business. Another kind of blended strategy, if you're going to be loaning money, is to consider selling the note, not immediately, but maybe in 3 to 6 months, right? So if you fund that same $400,000 deal, you fund that deal, in the first 3 months, you collect all the interest payments. At month 4, you now decide to sell it because you've collected 3 months. You want to sell the note, get your money back, you kept your fees, and now you've also collected 3 months of interest in addition to getting your money back. So, using kind of a blended strategy, whether you fund the deal, sell it immediately, fund the deal, let it incubate for 3 months, and then sell it and get your money back, or a combination of the two. These are just some of the strategies that you can use to deploy your capital, ensure your return, and get your money back, and do it all over again a week later. So with that said, some of the vessels that you want to use to deploy your capital. Obviously, you want to use Quest. That's a no-brainer. Obviously, you want to use L&H Capital, duh, right? But when we're talking about vessels to deploy your capital, what I mean by that is you want to have entities or agencies that understand the business, right? You want to have commercial lending mortgage brokers go out and find you the borrowers. These are the people that are going through finding you the credit worthiness. So even like local shops, right? L&H Capital has 16 offices, but we are based in Dallas. So if there's someone who's like, hey, I got $1 million I want to deploy, you want to contact an office like L&H Capital, like my office, to say, hey, I understand that you have a very crystal clear, lending platform. I want to contribute $500,000 to circulate. So it's shops like L&H Capital that can take on small investments, $500,000, $1 million, or $50 million investments, or everything in between. So obviously, I'm going to advocate for L&H Capital to be top of mind, but even still, more importantly, you want to focus on established lending groups or agencies, right? You want to look for lending correspondents. You want to look for someone who is already lending or facilitating the placement of money. You do not want to be going to market for the first time with someone who's never done it, doesn't understand protocols, who doesn't have processes and procedures in place, doesn't have the resources in place. You want to contact a shop that already has a process. Now, granted, there will be dilution in the profits made, but it allows you to operate with a lot less risk if you're not the one creating the underwriting box, etc. So, these are some going to be, some of the vessels. And again, I use L&H Capital, as a point of reference, but no matter where you are, you want to find a shop that already has an established business. So once you are set up with Quest, take on a shop to help move your capital to the qualified investors, because that's their job every day, all day. All right. So conclusion, I've been dropping all types of nuggets this presentation, but conclusion, I'm speaking to both borrowers and capital providers. So to the people who are looking to get money, and for the people who are looking to provide capital, find the relationship that is right for you. Trust me when I tell you, when a relationship does not fit, it makes the entire process painful, whether you're on the borrowing side or the lending side. Qualify each other before starting a relationship. Yes, as a lender, you are going to qualify your borrower with their credit, their experience, but similarly to borrowers, interview your lender. Ask them the necessary questions to see if they're the right lender for you. So yes, they're going to be qualifying you, but you need to qualify them, because if your lender's principles, processes, or just don't fit your investment criteria, you'll find that trying to take on money from them is a very painful process. Understand each other's requests and pain points. So as a private lender, as a private money capital provider, your pain point may be, I'm reluctant about pushing money out to high risk investors because I don't want to lose my money, right? I'm deploying all of my retirement to this one loan. So as a borrower, if I understand that my lender's pain point is getting the money turned around quickly, that may help me understand if this is the right lender for me. That may help me, call this lender when I have a specific deal, right? Or a specific relationship. So anything that allows me to understand what a pain point is for the borrower or the lender allows me to understand where I need to focus my efforts to satisfy that pain point. And that's how you'll be able to strengthen relationships. Do not follow the money. Never follow the money. Follow your gut. Your gut is the source of truth for any and everything you will ever do. Your gut is going to be your source of truth. So when you follow the money, you will often find yourself saying, hey, I should have followed my gut. I should have gone with my instinct. When you follow the money, when you follow your gut, the money will come. Pay attention to habits and communication manners, right? Pay attention to the habits. If you're the lender, pay attention to the habits of the person you're loaning money to. If you're the borrower, pay attention to how often or how accessible your lender is, right? If you can't reach your lender for days at a time, imagine not being able to speak to your lender the day before, the day of closing, and not hearing from them. Conversely, lenders, If your borrower gets upset every time you say anything to them, every time you impose a rule, just imagine what it's going to be like when money is tied up, when the money is tight, when the deals are running long and frustrations are flaring. So you want to pay attention to the habits of the people that you're doing business with, because in situations where there's a lot of money involved, those habits are exacerbated extensively. Focus on the relationship, the money will come. My first 16 deals, the reason why I didn't look for another lender my first 16 deals, because the relationship I had with the person that was providing me the money. They made sure I understood the process. They made sure that they provided input to help me grow. They made sure to just be involved. And conversely, when I needed to perform quickly, they were able to come and perform quickly. So by me focusing on the relationship, it allowed me to get better loan programs. It allowed me to have money deployed quickly, all that good stuff. So when you focus on the relationship, no matter what part of the transaction you're in, you will find that will always go farther than saving $1 if you're on the borrowing side, or making the dollar if you're on the lending side. Be comfortable with your risk or cost tolerance. What that means is, if you're a lender and you're going to be pushing out $500,000, which is your entire retirement, you got to be prepared. The rule of thumb is, if you can't afford to lose it, you can't afford to invest. So when people are antsy about the money that they put out, you will see it. And not only will you see it, it will become a nuisance to deal with. So if you're borrowing money and you're going to pay 6 points or 5 points or whatever origination fee or whatever interest rate, be comfortable with what you're paying. Do not throw it in the face of the lender that's providing the capital, because again, you agreed to it. So if you're not comfortable with what you're paying, lenders, if you're not comfortable or you're on edge about the money you deployed, then you either need to consider exiting by selling the note, or you need to consider not even pushing out loans. You're on the same team, right? I see a lot of borrowers and lenders look at who can edge each other out, or who has the bigger ego play, or whatever it is. You are on the same team. And when you operate against each other, it shows in every aspect of the deal. So the more you embrace the idea that you want the person you're loaning money to succeed, borrower, you want the lender to make money, the more you embrace that whole team concept, the easier the relationship will be, the easier the capital will come, the easier the capital will be requested. So I appreciate everyone taking the time to listen. I put out information like this on a regular basis. I'm on social media, Facebook and Instagram, Adonis Lockett. Feel free to email me directly, adonis@lnhcapital.com. If anyone has any deals that they want to get funded, anyone has capital they need to get deployed, feel free to reach out to me, reach out to my company, my staff. I'm located right in Irving, Texas. Feel free to stop by and meet myself and the team. We'd love to do business with anyone who's looking to do business with us. So again, appreciate the time. All right. Kurt can't hear you.
There we go.
There we go.
Awesome, Adonis, as always. I mean, I've heard you speak a lot, and I always take away a lot of information. I mean, even before I knew you were damn near an astronaut, I always thought you were a smart guy. So some of the things that you touched on, and, since we're Quest Trust talking about some IRA stuff, some of the things that you touch on is things that we talk about every single day with our clients and non-clients. Big thing that jumps out is due diligence, and not learning when to walk away from a deal, because there's always going to be another deal. And I think when people talk about their due diligence, many times they just talk about the deal, but they don't talk about that other piece, which is the people.
Right.
And people can make or break a deal. So in your experience, I know you touched on a few different things in terms of what you look for in good partners, good people to invest with. But if you have a checklist about people, I'd be curious about that. What kind of questions do you ask when you're talking about due diligence? Because a lot of people, when they hear due diligence, they just think it's a very broad term. But if you could kind of narrow it down to 3 kind of key things, what is it that you look for?
Are we talking about just in general, or if I'm talking to a potential lender, or if I'm talking to a potential borrower?
I think in general, but if you can distill it down, that's fine too. Because I think there's going to be some commonalities among the 3.
Sure. So first thing, when I'm talking to in any relationship, the one thing that I'm looking for is commonality in morals, right? The moral compass. As a lender, I have the opportunity on pretty much almost every deal, especially when borrowers are in tough situations, to take advantage of them by price gouging, by or inflating costs or interest or whatever the case may be. And the one thing that that has become most important to me is making sure I do business with people that have the same ethics and morals that I do, right? And what I found is that the people who are money hungry will usually put those principles in the back seat to making the dollar. So the first time where the dollar is more important than the relationship that the dollar is behind, that's when I realized that it's at some point this relationship will go left the moment there's a discrepancy about the dollar, and that's a relationship I'd rather not even bother entering to in the first place.
Totally agree. I mean, just being investors as we all are on here, I think we have all had that experience, and you kind of, unfortunately or fortunately, depending on how you look at it, you learn through those experiences and kind of what your own line is that you draw in the sand, that
right,
I'm not crossing this because there's always going to be another deal, and I'd rather do business with people I like, trust, respect, those kind of things.
Exactly.
You kind of touched on in the intro, and I think you alluded to it a couple of times about how you really got your business going because of utilizing IRA funds.
Right.
And many people don't even know that that's something that's available to them. And if I could expound on kind of what you said is, if you prove to be a good borrower, you're going to find yourself a lender for life.
Yep.
And if you prove to be a good borrower, well, now that lender is going to be chasing you down. Hey, did good last time, let's do it again. So it's kind of an extension of what you said about that moral compass and just being around people that you like, trust, respect, and have a good track record. With what you're doing now, as you've advanced, where does the private money from IRAs come in to what you're doing now?
So, the thing about being institutionally backed is that it's a across the board requirement for the way everything gets done. So there's very little opportunity for customization for the market, right? So in Texas, I am actually amongst the least competitive lenders, leading up to just getting a small family office to inject capital, behind us. But at one point, I was probably the least competitive lender in Texas, or at least I thought so, because we had a California mentality coming into Texas, and everything in California was, 3 weeks. Everything in California was 20% down. Everything was this and that and this and that. And when you come to Texas, when I would tell people these loan terms, they're like, dude, every lender under the sun is doing better than you across the board, and I wouldn't even be considered. So what I've learned was that there has to be diversification in the monies that comes in and is deployed. And that's why I made a point. You got to make sure the relationship is right for you. So a California lender providing capital in Texas in 2017, 2018 was not right for me, because they wanted 20% down. They wanted, all of these things, where in Texas, we were doing 100% financing. We were closing in 3 days where I needed 3 weeks. So what I found was that by taking on local or private families or the single investor, I was able to make the adjustment and be competitive in the Texas market. I understood how the big institutions ran it. So I was able to take, let's say, Kurt, your money, I knew exactly how to safeguard your money as an individual, provide structure to it, provide a clean exit for it, but still be aggressive and competitive and deployed in Texas. So that's why even as big of an operation as we've gotten over the last couple of years, we actually still do take on individual investors, because your one deal, your one 500K may allow us to turn the Texas only deal that the California institutions will never take interest in.
Makes sense. I know we had a lot of questions as it related to the content, and I would just tell everybody, reach out to Adonis, reach out to his team. Adonis, and I'll say, I'm not just trying to, make this a puff piece about Adonis. I mean, he's legitimately a good guy, but he's been very giving of his time since I've known him. So, I mean, if you call him, you email him and his team, they're going to have a solution to your problem. Whether they can directly solve that, then guy's got a pretty big network, so I'm sure he can point you in the right direction. What have you got coming up here in the next few months? What events are you going to? What's going on? Where can people meet you?
I'm definitely coming to that September event. So that's the big thing. But for what my goal is to create a loan program for every investor type, right? So in Fort Worth, and especially in suburbs of Dallas, Houston, a lot of investors are buying these $30,000, $40,000, $50,000 properties that all of the institutional back, all of the money that I have institutionally backed don't even bat an eye for that. I want to have loan programs available for every investor type from 30,000 to 75 million. So my goal is to become the true operation that has a loan program for everybody, regardless of what the strategy is. Because like I said, relationships are king in this business. And the more I can create these loan programs, the more I can create the relationships that will in turn help L&H Capital grow. So by making capital available to everyone, and mind you, me being an investor myself, I understand how investors want capital deployed. Right. So I'm very aggressive about making sure that we have loan programs where borrowers can keep as much money in their pocket, focus on getting the deal versus bleeding out everything when they close the purchase, putting everything down, blah, blah, blah. So my goal is just to make a loan product that accommodates the investor, because I understand the investor being one myself.
Right. I think that's a very key thing. And I think that's a great note to end on, and a takeaway that everybody should have. And that's to each their own. But I think when you're doing investments and you're working with other people, probably a good place to start is with people you like, trust, respect, but also they're doing what it is, what product they're selling you or what they're working with. You go to meetings and you hear the wholesale guy that has done a wholesale in 25 years. I think the fact that you are an active investor, you're eat, sleep, breathe, that you do exactly what your business does, that's a really good start for anybody who's looking to do business. So Adonis, I know we're going to talk soon. I'll be up in Dallas here in the next couple of weeks. So always look forward to seeing you. It's been a pleasure having you on here, and I'm glad we were finally able to bring you into the fold, man. It's been awesome.
Absolutely. Again, this is a checkbox off my bucket list.
Well, I was happy to play a small part in that, man. Anytime.
Right. Thank you for having me. And again, anyone listening in, feel free to reach out to me. I'd be more than happy to answer any questions you guys have.
All right, man. It's been awesome. Appreciate it very much, everyone. We're going to go home now. If you have questions, again, reach out to Adonis, reach out to any of the IRA specialists. We're happy to help you. And again, this has been another of our world famous education series with Quest Trust Company, the voice in self-directed IRA education. Take care, everyone.
Thanks, guys.